This is Dylan from Shoulders of Giants. Today I'm going to do another video about Funding Societies, which is a P2P lending platform. If you're new here, welcome. And if you're not, thank you for supporting the channel. And if you really like my videos, please leave a like or comment. And I'll do my best to provide the most value for you. And here, let's get started. So, what is Funding Societies? So if you think about funding societies, it's basically it gives the public or like a layperson the opportunity to be like a legal along or as we say loan sharks, but you're doing it legally through their platform. So what is actually a P2P lending platform? So you can think of that funding societies, they basically act as a middleman for you. So the cycle that it goes is like that. First, you deposit your money onto their platform. So they have a online web-based platform and also an app. Today, I'm just going to show the online web-based platform and not the app. But if I have time, I'll record my phone and put up sort of a review and walkthrough of the app too. So you put your money into their platform, and then they take your money and they lend it to businesses. And most of these businesses are small to medium enterprises. Um, Anywhere it can range from a few hundred thousand to like somewhere in the low millions where they lend it to businesses. So funding societies do this due diligence on these borrowers. So they check the borrower's history with them. They check what industry they're doing, and then they give you a report of all these things, and then they lend the money to them. But this lending part is there's a bunch of nuances out there. You can choose to manually lend your money to each businesses, meaning that you see funding societies due diligence and you manually lend them, or there's another way, which I will show you later, where you do auto invest. So you can set like some parameters in their platform and the platform will just auto invest your money. So these loans that they give to these borrowers, they charge the borrowers interest that comes with the loan. And then when the borrowers pay back funding societies, they pay it with interest. And then funding societies basically pay you back the interest minus a service fee that they pocket. So that's how funding societies make money. They make money from a service fee of the interest. So borrowers pay them back with interest, and then they pay you the interest and they take a service fee, take a cut. So it's a pretty simple concept, but which can give very interesting interactions. So let's get to the platform. So this is the platform of my own account. And I started basically last year around July. Yeah, July. So it's a little bit over a year. I initially deposited just 1,000 ringgit. I just wanted to test out the platform. And as you can see here, my annualized returns rates is about 9.84% per annum. And this amount, 4,600 ringgit total invested, is the total amount that I've invested, meaning that let's say I invested 1,000 ringgit already, and then the borrowers repay my amount, and then funding facilities help me loan it out again. So this is not my total amount that I deposit. My total amount is just 1,000 ringgit. Total invested meaning that the amount I've already loaned out. So it includes the money that's been paid back to me and then re-loan out. So this is like a 12-month chart you can check here. And you over here they even give you a breakdown of like your total income. So my total income is 205.33, but you have to see that this 80 ringgit is based on referrals. So if you cut this out, my actual net interest received is 118.83. So and then they even show you the fees. So it's pretty transparent. And I read one thing I like about funding societies is that they are actually very transparent with how they take the service fee, how the borrowers pay interest, and it's all reflected in their statements. So here they take their fees and then net income. So it's income minus expenses, and then this is net income for you. For now, there's no GST, so that's a good thing. After 1st of June 2018, there's no GST. And in their platform, you can go to my dashboard, and so you can check out the investment opportunities. Right now, they have no investment opportunities. It's zero. But when there's investment opportunities, you can go here and then you can go and click and read through them. They would they will give you a fact sheet for each opportunity, and then you can read through and decide whether you want to invest or not. So as you can see, the investment opportunities, they have three types of investments right now. There's a business term, accounts receivable, and accounts payable. So we can go through their help page and see what does it mean. So business term basically means it's like a general loan for the business. The business can use this loan for whatever they want, and it ranges from 1 month to 24 months, and the interest is between 8 to 18%, depending on the risk of the borrower. So as you can see, they give you when like a schedule of when they'll repay. They pay 8th month, 15th of the month, 22nd of the month, and you can expect your payments within 7 days. So this is business term financing. And then another type of loan that they give out to borrowers is accounts payable. So this loan is basically for the business to purchase like raw materials. So you can read about here. And this one, the service fee, they take up to 30%. Usually for the other loans, they take 15%. So this one's for the businesses to buy raw materials. And then the last one is accounts receivable. So this one is basically it's like sort of businesses taking like small loans. This one, the range is also shorter, 15 to 120 days. It's basically they're trying to get money for their to ensure their future sales. And once they get their future sales, they can repay back this loan. The one difference about accounts receivable is that the borrower can choose to repay early. So let's say the borrower repay early, so the interest would be less too, because there's no early repayment fee for the borrower. And if they choose to pay early, then funding societies would collect less interest because that's how they count the interest. It's prorated. And when they collect less interest, then less interest directly goes to you too, because you are part of the lender, right? And if the funding societies gets less interest, then less interest goes to you. But better to get less interest and knowing that the person paid back. So what are the risks of funding societies? One of the biggest risks of funding societies is that the borrowers go bankrupt, default. They have no ability to pay anymore. So if you go to Funding Society's website, this is their main website. They claim to have a 1.59% default rate, but they operate in three countries right now, Singapore, Malaysia, and Indonesia. And I believe this rate is the overall rate of all three countries. And they deliberately choose to put this rate on their website because it looks nicer. And I believe the Malaysian default rate is around 2%. And then maybe Singapore, Indonesia is much lower, and then the average out into 1.59%. If there's an article that I researched about called fintechnews.my, if you want to read, and it says funding societies has maintained about 2% default rate. So that's what I believe too. In Malaysia, it's about 2% default rate. So even through my experience, I did about 47 investments thus far. So if you can go here, you can see portfolio, and I did 47 investments thus far, and so far I've experienced one default case. So one out of 47 is about 2%. So do note that for every default case, it pulls down your analyzed return. So that is the risk there. And I can sort of tell you how to reduce the risk through managing who you invest with and the amount you choose to invest. So as you can see, they also show you the upcoming repayments and stuff. And they also show you each contract, like ongoing contract. And each of this is a loan contract between funding societies and the borrower. And if you, they even give you PDF statements to read. And if you click open, let's say I already looked this up previously. This is a 008, ending 008. This is one of their contract. So you can see who they lend money out. So this money is a private, this borrower is a private limited company. It is involved in wholesale fertilizers and agrochemical. This is their own credit score that they give uh, of the SME credit score. So it basically decide how good or how risky this SME is, and you can read about the credit score and how they derive it. And then they show you what are they, how much they borrowed. So the total annual rate is 12%. They did a 60-day term, so the interest rate you're getting from this is 2%. And funding societies takes 15%, so this is the net interest you're getting, 1.7%. So you're getting 1.7% from this opportunity here. And depending how much you decide to invest, you get that 1.7% after 2 months. So it also shows like some general info of like who is the director and shareholder and stuff. So before you make a investment, you can read all these fact sheet and choose whether to decide or not. But for me, I want it to be as hands-off as possible. So I do something called auto invest. So I'll show you later. And this, I'll just show you another fact sheet of this one, 006. This is 006. Similarly, it shows you the amounts they borrow and the percentage, interest percentage, net interest, and how much funding societies take. And this also they give you probability of default. So if they know the probability of default, they'll state in this statement as well. And then, yeah. So before every investment, you can choose that. But if you want to be as hands-off as possible, funding societies has this thing called auto invest bot. It's basically a investment robot you can think of like a software or like a just an executable auto invest function for you. So you can see here I'm open to invest in all kinds, whether accounts receivable, business term, or accounts payable. I set my limit to 100 ringgit per contract. So my understanding is that if you the minimum is 100 ringgit. So my understanding is like if you invest in many contracts at once, you diversified your risk, and if even if one of them goes default, at most is you lose that 100 ringgit. So let's say if I create a new bot, you can create here. You can choose which type of loan you want to invest in. Let's say I want to invest in business term financing. I can even choose the industries. So for me, I choose all because I just want to invest in everything and at a minimum 100 ringgit, and I just diversify my risk. And then you can set your percentage too. For me, I don't really care. I am willing to invest anywhere from 8 to 18%. So I just choose the full range. For this one, I try to go to 3 to 6 months. I was previously at 6 months. My future plan is to maybe go to 3 months. The reason is that if you go longer, so let's say you want to withdraw your money, it takes longer time for funding societies to recoup your money. So if the contract is 6 months, then the borrower has 6 months to repay fully. So here you can set your amount. So minimum 500 ringgit, maximum 50,000. For me, I set to 100. So I want to loan out as many 100 ringgit as possible to as many borrowers. So so that's the idea of it. And yeah, you can see I have three bots over here. I do 30 to 90 days financing, 100 ringgit, 1 to 3 months, 1 to 90 days. Previously, I was at 6 months, but I shortened it to 3 months because I decided to limit my risk and go for shorter term financing. So that's about it for the auto invest side. Oh yeah, here there's a max issue exposure. So you can set this amount to, I set it to 1%. So it's nice that it gives you an example. So 1% meaning that it limits your maximum amount of how much you invest in a one company. So let's say ABC company, you already invested 6,000 ringgit, and then they repay you 1,000 ringgit. So exposure to that company is 5,000 ringgit. And let's say you already invested 20,000 ringgit to other companies. So this company you invested 5,000 and then 20,000 to the rest of the all your other companies. So 5,000 over 20,000, you have 25% exposure risk to ABC company. So I limit it to 1% so that I can have as many companies and as many loan contracts as possible to diversify my risk. And so that if if uh, if there's an unfortunate event that one of the companies defaulted and they cannot repay their loan, at least it's just 1% of all my investments. So that's my thinking and that's my idea, and it provides me about close to 10% of annualized return. And yeah, it provided me about 141 ringgit of expected returns so far, and about 10%, 9.84% annualized return. So I'm pretty satisfied with the performance right now. I'm still testing out the auto invest bot. If I can get one thing I would like funding societies to do is actually lower the minimum amount from 100 ringgit maybe to 10 ringgit. That way I can invest in like 1,000 contracts of like 10 ringgit, or like more and more contracts 10 ringgit, and I spread out the risk, and the risk spread out to well, you can say that the risk is spread out to more lenders, and so the risk on the individual lender is lower. But let's say you want to do manually, you don't do auto invest, you manually go through the fact sheet, like you manually go through each of these fact sheet that funding societies provide, and you choose the industry and the contract that you highly think that it is they won't default, they will pay back and a higher return. If you manually go through that, then yes, maybe you can get a very high return, and you uh, don't even want to use the auto invest bot, or you don't even need a max issuer percentage. And then, but that is very hands-on. That needs a lot of research and knowledge of the industry, of the risk of the company, and maybe some financial calculations. So for me, I want to be as hands-off as possible. I want to make my investment work for me and not me working for the investment. So I do auto invest bot. I try to limit my risk, and just spread it out to as many contracts as possible. So I really hope to see funding societies provide like a amount where you can spread out your risk to just 10 ringgit and just 10 ringgit at every contract. So for now, let's go through the pros and cons of funding societies. So the pros is that it's one of the diversification of investments. So for investments, you can invest in stock market, real estate, ASM, so this kind of things, right? Bonds and stuff, FD. So P2P lending is diversification of your investments. So your investments is not just in one source. It comes from many sources. So let's say if one of the industries tank, like let's say real estate tank, but businesses are still running. They still need to borrow money, and funding societies is still making money. So that's diversification. Second point is that you sort of get to help SMEs because they are getting money from you and you're getting interest from them. Uh, I like the auto invest feature. It saves your time, and it helps you diversify it, and it has decent returns. I've seen people getting more than 10%. Some people even get to like up to 12%. So it depends on how you actually set the auto invest pot. and maybe if you do some manual investments, it will go higher. So what are the cons? The cons is that it can be a hassle to withdraw your deposit as you have to wait for the loan term to end. So let's say your loan term is 6 months, and even though you stop all auto invest bot, you still have to wait that 6 months for the borrower to repay all your payments, and then that's only when you can get your actual full amount out. So the second point is that the defaults can pull down your returns significantly. So I would say the like one default can actually affect your uh, annualized return by a good amount. So that's something to take note. And if you do an auto invest, basically you're trusting funding societies to do their own due diligence on the borrowers that they select. I think this is not that much of an issue because funding societies, they too, they want to make money, right? They take a service fee from the interest that they collect. So I'm pretty sure they do some kind of pretty solid due diligence to actually choose borrowers that can repay the loan. So, but it's like if you don't have too much trust in funding societies, it can be a con. Maybe you don't think they're doing a good enough job of selecting proper borrowers. So that's one of the cons. So I guess this is my brief review on funding societies. There are a lot of other things that I didn't cover issue because funding societies, they too, they want to make money, right? They take a service fee from the interest that they collect. So I'm pretty sure they do some kind of pretty solid due diligence to actually choose borrowers that can repay the loan. So, but it's like if you don't have too much trust in funding societies, it can be a con. Maybe you don't think they're doing a good enough job of selecting proper borrowers. So that is one of the cons. So I guess this is my brief review on funding societies. There are a lot of other things that I didn't cover of like funding societies where you can go and read through the fact sheet, the statements, and other things. But if you'd like to know more, maybe I can give you a walkthrough of the app. The app also is in my opinion is very nicely designed, and it gives you a lot of information. And please let me know if you would like to see more videos like that, and leave a comment below. And if you like the video, please consider liking and subscribing. And yeah, that's all for today. And I hope you enjoy it and get some value out of it. And take care, everyone.